Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending March 18th, 2022. I'm Preston Brent. Thanks for tuning in. Well, if you drop a ball off a balcony, it's going to certainly bounce. And if you drop the markets from all-time highs, well, it's going to eventually bounce as well. Now, the key is this a dead cat bounce or are we going to continue price momentum higher? Well, let's go take a look at the charts, kind of see where they're going. But, the first thing I want to do, let's just take a look at the last week and just kind of see where we were this past week. Record-setting numbers in the week. Look at these weekly performance numbers. Up 5.5% for the Dow, 6.1 for the S&P, a whopping 8% for the Nasdaq. Russell, 5.3%. Now, we're still in the red year to date, but huge moves. The Dow rose. It snapped a 5-week losing streak. Nasdaq, huge move here. It was like one of the largest weekly gains it's ever had. So markets we're seeing are kind of supported by a lot of different things going on right now, including falling oil prices, some kind of hoped negotiated settlement out of Russia and Ukraine. Russia not defaulting yet on their sovereign debt, but I suspect that's going to happen soon. And then, of course, we had the big outcome with the Fed monetary policy meeting this past week. And then we've had some technical damage to the charts as well. I mean, the 50 EMA moved below the 200 EMA. As I've been talking about, it's called a death cross. Dow Jones Market data, they basically say there's been 53 death crossed episodes going back decades. The average gain after we have a death cross going out 12 months in time is 6.3%. Probably the primary reason is when you get a 50 crossing below the 200, it takes so long to set up that you are getting a bounce, but then the markets tend to move up. I've always said that the death cross tends to be an area where markets find resistance when they come back up into it. And then they start to roll back over again. So we're going to take a look at the charts in a minute, just kind of see how everything shapes out. You can see the trailing PE ratio 24.53 in the upper right. The forward PE ratio has been dropping dramatically. You can see the latest PE ratio is 16.52. It's been very stealthy, an orderly move, but we've had that big move lower. I mean, the PE ratio was over 22 back towards the end of last year. And we've seen a lot of the tech stocks take it in the shorts with PEs falling, especially those tech stocks that have no earnings and small balance sheet cash, right, on hand. Dividend yield for the S&P 1.42, 10-year Treasury 2.15. So the Treasury is still 73 bips higher than the yield. So, eventually that's going to start pumping money into the Treasury market. Earnings yield for the S&P still at almost 4.6%. And there's a difference of 2.44%. You get more yield on the S&P, including equity appreciation and dividends. If you only include just dividends, it's 1.42. But when you include the equity appreciation, it's still running at 2.44. But the real yield, when you throw inflation in there, is still a minus 5.46% and negative. So you're seeing money take bigger risks to try and make up for that higher inflation. No, I didn't update it on my chart there, but the VIX has come down dramatically. I mean, just a big time amount. The VIX closed the week at 23.87. You can see last week it closed at 30.75. All right, and so we've fallen 7 VIX points over this past week, and we should because the market's moved up so much, right? I mean, just fallen a good deal. You can see the best performing sectors discretionary up almost 10% for the week. That means money's coming out to spend. Energy year to date still doing good, but obviously pulling back from the recent highs. Energy had the worst performer for the week. Communication services the worst for the year, still underwater by 12.17%. Now, if we get into the numbers just a little bit this past week and just take a look, if we look at some of the economic data, well, I mentioned we did get the Feds hiking their rates, but before that, the retail sales were disappointing. January numbers were revised upward, but continuing claims for unemployment also fell to a 52-week low. Mortgage rates soared over 4%, first time in almost 3 years. PPI index decelerated in the month of February, but it's still extremely high. All right, so inflation is here to stay for a while. Okay, and if we look at U.S. Treasuries, well, as expected, the Fed's raised its short-term lending rate 25 basis points. That's a quarter of a percent. And by the way, that was the first rate hike since 2018. Okay, so that moves our Fed funds target rate to the range of 25 basis points to 50 basis points, right? So they always keep it within a range, and there's kind of free floats within that range. The Fed's also released an updated economic forecast, which showed they're expecting to raise rates 7 more times this year, or that was 6 more times, 7 times, including this past week. That's a lot. I don't think they're going to get there. Personally, I think they'll probably stop after 2 or 3 because the markets aren't going to be able to handle it. Treasury yields also shifted higher in response to more of these hawkish signals from the Feds. The yield curve flattened, or it continues to flatten. Now remember, if the yield curve moves below 0, that's the 2s over 10, the 2-year over the 10-year. If it moves below 0, then it really dramatically increases the odds of a recession 9 months out in time, 9 months to a year out in time. And already the analysts are projecting probabilities of inflation or recession happening towards the end of this year or early next year, over 35%. Others have it at 50%. We'll see how that plays itself out. Okay. Now let's go over to Europe. Take a look at Europe. Just like the US, everything was in the green, right? Well, that ain't Europe. Europe, I doubled down on that one, didn't I? Europe, everything was in the green, looking really strong. The Bank of England raised their rates 75 basis points or 75 basis points from 50. So they raised their rates 25 bips as well. All right. So they started the rate hikes. This is their 3rd rate hike off of, being neutral for quite some time. Their inflation in the UK is running just slightly around ours, around 8%. Okay. Meanwhile, the ECB president, Christine Queen Bee Lagarde, she appeared to strike a more bearish tone, while the Bank of England, even though they raised the rates, they seem to forecast a little bit more dovishness going forward in time. Okay. So that's Europe. And then, of course, if we look at the Asian markets, Japan, they've had now 5 consecutive days of markets moving higher. Their week, they finished up over 6%, a strong week for Japan. And we've got sentiment out of the Bank of Japan. They're continuing, just like China, to be more dovish. And they're actually the only 2 central banks globally that are actually putting more money into the economy. Japan is one, China's another, right? In Japan, their short-term policy interest rate is still at a minus 10 basis points, and they've targeted their 10-year treasury bond at 0% interest. So they're continuing their quantitative and qualitative monetary policy easing. So the markets like that over in Japan. And then, of course, over in China, they were actually down a little bit today or this past week. But they are just like Japan, introducing market-friendly policy measures to keep the capital markets running smoothly. Okay. They did expect or reported better than expected production. Okay. Industrial output rose just a little bit, but they're still hurting. The whole Chinese economy is hurting right now. And it really started last year where they really went into a bear market, and they floated in and out of a bear market all last year. So to kick this year off, they've moved up just a little bit. Some of the Chinese stocks like BABA, JD.com, and a few others bounced really strong this week. The SEC is requiring Chinese stocks to submit to stronger and tighter audit regulations, and they're kind of meeting China a little bit more than halfway. So that helped those stocks out. But I would be very careful if you're trading any ADRs that are Chinese stocks or that, because they could just delist them in a heartbeat and you're going to be stuck, right? So be careful with those stocks. So if we come over here and we look at most of this, let me just see if I've got over here like this. If we look at where we've been over since 1920, you can see the average bear market each decade is 2.3 bear markets per decade. Okay. You can see those decade returns. This is the SPX cash index. In the 30s and in the year 2000s. In 2000, we actually had 4 bear markets, believe it or not. They just kept coming, bing, bing, bing. Generally, we have the dot-com bubble and then the '08, '09 great financial reset. Even in the recovery, there's short-term bear markets bouncing off the lows and then rolling over and bouncing again. We continue that. But you can see the decade average performance. And we've only had just a few decades where the performance was in the red. That was in the 30s and the 2000s. So far in the 20s, when we kicked off 2020, we're averaging about 17.63% since January, the first trading day in January 2020. That does include the COVID crash. Okay. We've had one bear market already, which was COVID, but the average is 2.3. So that would suggest we're going to get a bear market, which I do believe we're going to get hit with a pretty good little bear market. I would think probably in 23 or maybe into 24. It's going to be an ugly one too, guys. For our members, we've done really well in bear markets, and this one shouldn't be any different. We've been playing the downside. We're profitable. We've been profitable all year in the markets, playing this pullback. I still think we got a little bit more pullback to go, but we'll see. Let's go take a look at the charts just so that we can kind of see where those things are shaping up. So let me just switch the screen over here, just like this. And then I'm going to wait for the screen to come up for you guys. And then we'll go into it. What's going to come up is the S&P E-mini futures. You can see here this huge bounce off. Now, one thing that's very critical that I was watching very closely, and we were able to actually go into close before it. To me, the key level was the 50 and the 200 EMA. Sitting right around the 4,400 to 4,406, you can see that price level there. You can see that candlestick just closed right at the top. So we took these out. So there is a very high probability to retest this level. Now we're at 44.65, so that would entail a pullback of about 55 to 65 points. But when the VIX is still very high and elevated, even with this big move higher, the VIX still is over 25, then you can see here that this test is probably going to happen this week, I would expect. It's going to digest this big move off the lows. Now, our year-to-date lows are also off the all-time high of 14.69%. This is the 2022 low that came in on February 24th. And you can see we had a move up here. We could not get over the 200 EMA. We rolled back over. We solidified that low right there, and then we move up, and we took out the 50 and the 200. This move right here was a very typical of a bearish chart, a bear market chart. And that's what I was expecting, another rollover. Because we did not get it, that changes the market dynamics near term just a little bit. So that means what I want to do is just watch and see where we go. Now, overhead resistance is going to be, there's a little bit of a zone right here and then a bigger one at 45.86. I do not see us getting up there this next week. It could, anything could happen, but the odds do not favor it. The odds favor a little bit of a retest to the 4,400 level. And then if it holds up, then the odds start to improve that we're going to come back up here again and take out the highs that were made on Friday and continue up and then run into a little bit more of a stall here. If we run into a stall here and then start to roll over and then take out the 50 and the 200 going back down again, then the odds dramatically increase that we're going to take out 4,100 and move down to the range that I was forecasting, which was 3,800 to 4,100. All right. That doesn't put us in bear market territory. It puts us very close, but not quite. Okay. So, and if I were to put a regression line on this downward move like this, just so that you can do it, and I'll regression, I'll put the high point and then the low point right here. And you can see on Friday, we had that key level right there sitting right below the 200, and then boom, we bunched out of the regression channel. Just a beautiful move out of it. So we should expect a little bit of a retest, and if the momentum helps us out, we'll move back up. But that's going to be a key move, guys. It's going to be a real key move. We got to watch to see how it plays itself out for us. Okay. And of course, if we come and look at Nasdaq, Nasdaq is on fire. Huge week. You can see we've already had a death cross in Nasdaq. I always say the death cross is a resistance point where price action tends to move towards. We were down in a bear market officially on March 15th in Nasdaq 100 futures. All right, we were down 22.31% from the all-time highs made last November 22nd. So we've moved back up here now. If we roll over here and we cannot hold it, that's going to still push us back down again. So we've got a number of different dynamics working out here. We're nowhere near out of the woods yet, guys. The only way I believe we'll be out of the woods is if all indexes move over their 50 and 200 and then they become support. We're not there yet. We're getting some little bit of a divergence in these indexes, and that does cause issues. Okay. But you can see that big move here with Nasdaq over this past week. Just a huge candlestick move. If I were to put it on a weekly chart, you can see the breadth of this move right here. Just, and that's a bullish divergence candle. I mean, we made a lower low and much higher high on the previous week, and it was bigger than that week there when we had that big move lower. Right, so we're coming up, and you can see the MACD well below the zero line on this weekly chart. And of course, if we look at the RSI, we didn't get really too far oversold, but on a daily chart, we were, right? If we come back to a daily chart and look at the RSI, you can see we started flatlining to get a little bit of a bullish divergence there as we were going lower, all right? So that suggested we were in for a bounce, but now will it hold? If we don't get over this 50 and 200 NASDAQ 100, then we could roll back lower, and it could pull the rest of the markets down with us, okay? And then, of course, if we look at the Dow right here, Dow also moved over their 50 and 200. We've already had the death cross in the Dow, right? And you can see here that I want to see us hold this level up. We've got to hold these key levels. If we don't hold them, then it's a bear market. It's a dead cat bounce kind of thing, and then we roll back over. So we're not anywhere out of the woods yet. Okay, remember, in a bear market, some bull market, some counter cyclical, which would be a bullish rally, can last for a few days to a few weeks, and then it rolls right back over again. Okay, coming nowhere near the prior all-time highs or the highs before the bear market rolls. So we got to watch this very, very closely. Okay, and that's what we're going to be doing. And then finally, if we look at the Russell was the most damaged index. You can see we had a death cross back over here in early January. I mean, the 50s moved over. So we were able to regain the 50 EMA right here. 200 EMA still sitting well north. We were in a bear market also on the Russell around the 24th of Feb, along with NASDAQ 100 futures. And you can see here, we just bounced right out, came back up here. So we still got a lot of damage that's done to these charts, and we got to see where it's going to go from here. If we look at Dow Jones Transports, right? If we look at the Dow Jones Transports, again, this is really an interesting chart here, and you don't see this very often. But that's how fast this asset moved. We moved from 264 down to 245 and then back up to 268. I mean, it was just boom, boom. And that caused the 50 EMA to do a death cross and then roll back and cross right back again right away, right? And boom, we're up here like this. That's a bullish sign, but we've got to see these levels hold up, right? I mean, so and for our members this Sunday evening, I've got some interesting stocks that we can use to play some of these wild ass moves. Okay, all our other trades are working out fairly well, or at least what we've been running. So that's a little bit about Dow Jones Transports, and then of course, if we look at Bitcoin, Bitcoin's almost up to 42,000, but you can see here it's still got a ways to do. We had a death cross in Bitcoin back in January. And we've just been running in this wide trading range right here. Bitcoin seems to be correlated with the equity markets at this time. So when equity goes up, Bitcoin goes up and vice versa. unlike gold, right? Gold is a big inflation hedge, but it's also a fear gauge where the worse the situation gets in Ukraine, then gold tends to be a stabilizing force and a little bit of a hedge against the rest of a portfolio that may be in more typical asset classes, right? So that's kind of what we've got there. And the VIX, like I said, 23.87. I mean, look at this. The VIX has just come down hard from these highs here, and it's just been a straight shot down, right? We're still elevated. We're still well over 20. So that means there's still premium to be had. Now, if we roll back over, you're going to see the VIX come right back up again. So the markets are going to stay elevated volatility wise as long as Russia has tanks in Ukraine, because it won't take but a small miscalculation to fire on a NATO country, and then you've got a kinetic war between a NATO country and Russia, and then you're going to see volatility and everything else just fall right off the table. Volatility goes through the roof. The markets fall off the table. So we've got very wide tail risk, which basically means the markets, the way the option markets are pricing it, the markets can move really fast to the upside or really fast to the downside, right? So you've got to be very careful, keep your position sizes small, take profits faster during this kind of environment. And if we look at treasuries right here, bonds are kind of in a relief rally a little bit after this big move lower here. You don't want to be chasing it down here. Ideally, I'd like to see bonds run up. And then I would, we've been short bonds way back since over here. Okay. And there are a number of different ways to play the short trade, but these rallies here, what you want to do is be able to fade these rallies, right? And that's kind of how I've been suggesting to our members, and it worked out fairly well, okay, with these moves here. And you can play it in the bond market, or you can play it in ETFs that track the bonds. For our members, we'll review that this Sunday evening again, for your viewing pleasure. For the US dollar, well, Europe is hurting a lot more than the US, but as I said, this dollar should be faded down here. It's kind of holding up here, which I would not be surprised to see act as a holding agent for the US dollar index. Remember, it's an index, it's not the actual dollar, because it runs against 5 or 6 other currencies. I could see the dollar moving up, but you want to be more a seller of the dollar than a buyer of the dollar up in this area. You just have to withstand some of these chops. Now, if the markets roll over, money's going to roll into the dollar, right? Just because it's a when the markets are going down, everybody rushes to the dollar. So members, we'll go through this and what taking Russia out of the SWIFT system and how that does for the U.S. dollars, global reserve currency, and all that other stuff. We'll talk a little bit more in depth on that this Sunday for our weekly market watch. Okay, so that's a little bit about the dollar, and then of course if we come down here and we look at gold, well, gold. It's very choppy, but you can see here the run up here when the move into Ukraine really happened right around here. You can see when it moved in, gold took off, and now it's settling back in at the high level of where it was before Russia moved into Ukraine. They were just amassed on the border. Okay, so the minute those tanks roll out of Ukraine and they have some kind of negotiated settlement. Hopefully that'll be soon, but if that does happen, you'll see gold come back down into this area and consolidate a bit longer before moving higher. All right, so that's a little bit about gold. Silver's the same way. I prefer silver over gold, a little bit of a faster mover, but you can see here silver also went up, made a new high for this year, and then backed off the exact same amount. I would expect the 50 and the 200 to support each other. I'd expect the 50 to move over the 200. So we'll get the opposite of a death cross, the 50 moving over and act as support, firming up silver for a longer term slow move higher. Oil, well, I think oil is going to stay elevated for a while. You can see we came right down and hit the 50 EMA, this red line. I think we may move up. We may come back down, test the 50 EMA again. If and or when Russia leaves Ukraine, you'll see oil come back down again, all right? But you want to have some long stock and or positions in the energy market this year. I think it's going to stay strong all year long. Okay, that's just a little bit about what I believe. And same thing with gasoline futures. You can see gas futures kind of followed oil a little bit, but just a little, believe it or not, a little bit stronger than oil. with gasoline futures staying high. And members, I'll show you how we can trade gasoline futures without getting into the gasoline futures marketplace for those of you that want to trade it. Okay. There's also some really good stocks in the energy market that I do like as well. All right, everybody, that's kind of where we're just a quick down and dirty on some of the major indexes and where we're sitting at Friday's close. Members, I will see you Sunday evening. We got some stocks to take a look at as natural opportunities, some position plays, and we'll be looking at some of the things in our secret trader as well. All right, everybody, have a really great weekend. If you're not a member, I highly encourage you to come in and check us out. Otherwise, members, see you Sunday evening. Take care, everybody. Ciao now.